Right, good afternoon everyone and welcome to this Better with Money webinar, Switch on to Tax Tips. So just a couple of notes before I get started today. This webinar is intended just to provide you with information only. So it's intended to inspire you to take action around your finances. We're not providing financial advice today. We're also not connected to any other organisation and don't receive any commission from any company. So if I do mention companies along the way, it's just because we genuinely believe they offer good services, which you can take advantage of. So let's get started. So we're approaching the end of the 2020-21 tax year, but what does that mean when it comes to your finances? Well, in today's webinar, we're going to be taking a look at some of the things for you to consider before we move into the next tax year on 6th of April and why now is the time to act. So whether you're starting out on your savings journey or you're thinking about retirement, we'll give you some useful tips over the next 25 minutes or so about the tax reliefs and allowances available to you so that you can make the most of your money. Okay, so why prepare for the end of the tax year? So before we get into the detail, let's look at why this is a sensible time to check your finances. Well, importantly, certain savings allowances tend to refresh at the start of the new tax year, some of which you cannot carry forward to the following year. So this creates an almost buy now while stocks last scenario. There's also time limits placed on when you can claim back certain tax reliefs in respect of savings or expenses, with previous years falling away as you enter into the next tax year. But crucially, it serves as a frequent reminder to do regular checks of your finances, to assess your current position and whether you can afford to top up your savings and make use of those allowances. So it's worth setting this time aside each year to focus on your finances. Some things we'll look at today are influenced by the rate at which you pay tax, which can either be basic, higher or additional rate, or indeed you may be a non-taxpayer. So let's start off with a look at the tax that you pay on your wages from your employer. So your employer will use your tax code to calculate how much tax should be deducted from your pay before it lands in your bank account. So here's a snippet from an example payslip where you can find your tax code. The numbers tell you how much you can earn before you start paying income tax, and this is known as your personal tax allowance or personal allowance. So from 6th of April 2020, the standard personal allowance is £12,500. It could be higher if you get disability allowances, for example, or lower if you owe tax from the previous year's income, or you receive benefits such as healthcare or a company car that you need to pay tax on. But for most people, you can earn £12,500 before you pay any tax at all. So your tax code is your personal allowance with the last number removed and a letter added. So this will be 1250 for 2021 if you have no additional taxable benefits or income. The L means that you're in England, and this is an S in Scotland and a C in Wales. Next tax year, starting on 6th of April 2021, the standard personal allowance will increase to £12,570. Now, if you are married or in a civil partnership and one of you is a basic rate taxpayer and the other one earns less than £12,500, the personal allowance, every year, you might want to think about using the marriage allowance. So this is where the partner earning less than their personal allowance can elect to transfer £1,250 or 10% of their personal allowance to their partner to reduce their tax bill. So if you do decide to use the marriage allowance, you may actually be able to backdate your claim to include any tax year since 5th of April 2016, which is 4 tax years ago. An M on your tax code means you've received 10% of your partner's personal allowance, and N means that you've transferred 10% of your allowance to your partner. It is worth pointing out at this point that you cannot claim marriage allowance if you're living together, but you're not married or in a civil partnership. So it's always worth checking your tax code to make sure that it's right and that you're not paying too much tax. You can do this by referring to your last tax code letter, which we receive every year, or by signing on to your HMRC Gateway account. Now, if you work for multiple employers or work and you also draw a pension, you'll have more than one code. But what if you receive income from other sources outside of employment where tax is not automatically deducted? If this is the case, that you may need to fill out what's called a self-assessment tax return to ensure that you're paying the right amount of tax. So numerous instances in which you might be required to complete a self-assessment tax return, and we'll look at some of them today. So self-assessment is another way in which HMRC uses to collect income tax. And unlike employment income that's taken at source on a PAYE or pay-as-you-earn basis, it's up to you to check whether you need to declare any further income. As well as employment earnings, you may also be in receipt of additional earnings, such as through self-employment or from renting out property, or possibly in the form of dividend income or investment income. And completing a tax return will enable HMRC to ensure that you're paying the right amount of tax, if any, on these earnings. You might also need to complete a self-assessment tax return if you receive child benefit and you or your partner's income exceeds £50,000. If this is the case, you may be liable to pay the high income child benefit tax charge. Now, if your income exceeds £100,000 a year, you will need to do a self-assessment. And this is because when income exceeds this level, your personal allowance will start to be tapered down, reducing by £1 for every £2 that your adjusted net income is above £100,000. This means your personal allowance is zero if your income is £125,000 or above. Now, if you pay too much tax or you need to claim some back, you can also do this via self-assessment. There is a handy checker tool on the gov.uk website, which I've put in the box at the side of this slide, to help you determine whether you need to do a self-assessment tax return. If you do, and you haven't filed one online before, you will need to register by 5th of October following the tax year that you had the income, and complete the self-assessment by 31st of January the following year. Now, on to tax relief working from home. Now, as a result of COVID-19, many of you may well be having to work from home, perhaps for the first time, which is likely to result in additional day-to-day costs such as lighting and heating and so on. The good news is that the government provides tax relief to help towards these additional household costs, even if you've only worked from home for one day in this tax year. So let's have a look at this in a little bit more detail. So additional costs that you may be entitled to tax relief on are for things like heating, a new broadband connection or home contents, potentially also for equipment that you've bought, such as a laptop, chair or mobile phone. Costs that would stay the same regardless of whether you're working at home or not, such as mortgage interest, rent or council tax, are not included. And it is worth pointing out that you cannot claim for things like personal protective equipment. Now, you can either claim the tax relief on a set amount every week of £6. This is the rate from 6th of April 2020. For previous tax years, the rate was £4 a week. And for this, you need to keep evidence. You do not, need to keep evidence of your extra costs. Alternatively, you can claim relief on the exact amount of your extra costs that you've incurred above the weekly amount, and you will be required to provide evidence such as receipts, bills, or contracts. Now, tax relief will be provided at the rate at which you pay tax. So if you're a basic rate taxpayer, you pay tax at a rate of 20%. So the amount of tax relief that you would receive on the £6 a week is 20% of this, or £1.20. And for a higher rate taxpayer, this would be 40% of £6 or £2.40. You can claim the relief using the Government Gateway service. And if you haven't used the system before, you can create your Government Gateway ID in about 10 minutes or so. It's a good idea to have your national insurance number and a recent payslip, P60, or a valid UK passport to hand. The link provided here will walk you through the process, and they've simplified the form this year as well, so because so many people are claiming. If you complete a self-assessment tax return, you will be able to claim via this method instead. Alternatively, you may be able to claim via a P87 form, which you'll find on the gov.uk website, which can be returned either online or by post. Now, a few important things to note about claiming working from home tax relief. You must claim within 4 years of the end of the tax year that you spent the money. So if you think you may be eligible for previous years, remember that your chance to claim in respect of 2016-17 will fall away after the end of this tax year. If your claim is for the current tax year, HMRC will usually make adjustments needed through your tax code. So you may see a lower amount of tax being taken on your next payslip. If your claim is for previous years, HMRC will either make adjustments through your tax code or they will give you a tax refund. Now, let's move on to savings allowances. We're going to take a look at pensions and ISAs, or individual savings accounts, to give them their full name, in this section, and the allowances the government provide to incentivise you to save. So first up, we'll have a look at pensions, as these are still the most tax efficient way to save for the long term. You get full tax relief on contributions that you pay in. Your pension pot grows tax-free, and when you decide to take your income, you can take 25% of it as a tax-free cash lump sum. So starting with pension contributions, you receive tax relief at your highest rate. So for example, a £100 pension contribution for a basic rate taxpayer actually feels like an £80 contribution, as the government pays into your pension the 20% tax that you would have otherwise paid on that £100. And for a higher rate taxpayer, a £100 contribution feels like £60 due to the 40% tax relief given. Similar method again for additional rate taxpayers. Tax relief is given on up to 100% of your earnings, but it is capped at a limit known as the annual allowance. Paying in more than this amount will incur a tax charge. This year, the annual allowance is £40,000. So this is how much you can pay into your pension scheme, or schemes if you have more than one, in a tax year and still receive tax relief. Now, one important thing for higher earners to note at this point, and here I'm referring to those with total earnings of around £200,000 plus, is that you may be subject to the tapered annual allowance. And this reduces your annual allowance of £40,000 based on your earnings. And as you can see here, if you earn up £312,000 or above, you can only put £4,000 a year into pensions and receive tax relief. So if you think you might be affected by this, you may wish to seek advice that you know what you can tax efficiently save without exceeding your allowance. Even if you are subject to the tapered annual allowance, you can still make use of the carry forward rule. And this rule allows you to carry forward unused allowance from 3 previous tax years. So any unused allowance from the 17-18 tax year is lost after the current tax year. I have put the website link to the government calculator, which will show you if you have any unused pension allowance from previous years. Another allowance to be aware of is the money purchase annual allowance. This applies if you're already receiving pension income, but you're still working and want to continue to pay into your pension. If this applies to you, the amount that you can save into a pension and still receive tax relief drops down to £4,000 a year. So it's worth thinking very carefully before accessing your pension savings, as this could impact on your ability to continue to save and enjoy the associated tax benefits. So we talked a lot about tax relief, but how is it given? So in a lot of workplace pension schemes now, they operate on a salary sacrifice basis, which means that your pension contribution is deducted before tax is applied to your salary. So you receive tax relief at your highest rate directly through payroll. If this is the case, then you don't have to do anything to get the tax relief you're owed. However, there are also pension schemes that use what's called the relief at source method. And this is where your contributions are paid into your pension and the pension provider claims back the basic rate tax from HMRC and adds that amount to your pension. So if you're a basic rate taxpayer, there's nothing left for you to do, as your provider has claimed back basic rate tax, 20%, on your behalf. However, if you are a higher or additional rate taxpayer, you will need to claim back that extra 20 or 25% from HMRC yourself. And this is how a personal pension that you would set up yourself would work. Now, if this is the case, you can either complete a self-assessment tax return and claim via the pension contribution section, or you can contact the local tax office, sending them a schedule of contributions from your pension scheme, which you can ask your pension provider for, stating that you've been paying tax above the basic rate for X period and believe that you're entitled to further tax relief. HMRC will usually go back up to 4 years in respect of unclaimed relief, so anything before then may well be lost. The link here shown gives further details on making a claim and also links to further information about the various pension allowances that we've just looked at. Now, pension tax relief is one of the incredibly attractive features of pension saving, but there's no guarantee that it will be around forever. Pension tax relief currently costs the Treasury around £35 billion a year, and changes have been speculated for several years now. So it is worth having a think about whether you're on track with your retirement savings, and if you can afford to top up your contributions, bearing in mind the allowances that we've just looked at. So if you want to know what the difference an additional contribution will make to your pension savings, there is a pension calculator which you can access via the Better With Money website under the Employee Resources section. This calculator allows you to put in what you've already saved and how much you've been saving each month, and then set a target income, which will allow you to see whether you're on track. If not, you could consider topping up your pension. And by way of reference, people generally aim for around 2/3 of their pre-retirement income in retirement. The other reason that you might want to pay more into your pension is for tax planning. So when your salary goes above £50,000, not only do you start paying tax at the higher rate, but you also start to get reduced child benefit for those with children. And once you earn £60,000, you're not entitled to any child benefit at all. So if, for example, you're earning £53,000, it would be well worth thinking about putting £3,000 a year into your pension, as this will take your salary for tax purposes below £50,000. So you continue to pay basic rate tax at 20% and continue to be eligible for child benefit. It is also possible to pay into someone else's pension to allow them to reduce their income down for the purpose. So let's have a look at that in a little more detail. So tax planning isn't the only reason that someone might contribute to someone else's pension. Typically, family members may pay into a pension on behalf of a child or a grandchild to support their saving for later life. These contributions are treated as if they're paid by the individual, with the limits that would apply as if they were their own contributions. So tax relief and the various pension allowances apply in the same way. If contributions are paid into a pension for a non-earning child or grandchild, for example, then tax relief will be restricted to £2,880 before tax relief of 20% is applied. Now, if the person you're paying into is a working age adult, such as son or daughter, if they are a higher or additional rate taxpayer, they may be able to claim back the further tax relief from HMRC above the basic rate relief automatically given. Now, remember, any contributions made by a third party will be treated as a gift for inheritance tax purposes, which may be considered a potentially exempt transfer unless covered by an inheritance tax exemption. So let's take a quick look at the gift allowances now. So making a gift to your family or friends while you're alive, either as a pension contribution or a cash gift, can be a good way to reduce the value of your estate for inheritance tax purposes and benefit your loved ones immediately. How much you wish to give your children and other members of your family is completely up to you. So long as you live more than 7 years from when you make this gift, your children or family won't have to pay inheritance tax on the gift when you die. This is known as a potentially exempt transfer. Unfortunately, if you don't live more than 7 years after you've made the gift, they might have to pay inheritance tax, as shown in the table on the right-hand side of this slide. However, you do have a £3,000 gift allowance a year. This is known as your annual exemption and is the amount that you can gift each year without it being liable to inheritance tax when you die. There's also other gifts that you can give tax-free. You can give as many gifts of up to £250 and to as many individuals as you want, although not to anyone who has already received a gift of your whole £3,000 annual exemption. In addition, you can give wedding gifts, as shown on the slide. There's a really useful guide on allowances on the Money Advice Service website if you want to read more about it, and we've provided the link here. Right, so now let's move on to look at ISAs. So these are tax-free savings accounts whereby, like pensions, income tax or capital gains tax are not charged on any interest or profits that you make on your savings, and you don't need to declare this on your tax return. Unlike pensions, however, you do not get tax relief on payments into the ISA, but all payments out are tax-free. So every tax year there's a new ISA allowance, which means you can save up to this amount without paying tax on the returns made. The current ISA allowance for the 2020-21 tax year is £20,000, but unlike pensions, you cannot carry forward any unused allowance to a later tax year. So if it's not used this year, it's gone, with the allowance resetting then from 6th of April. For 2021-22, the ISA allowance will also be 20,000. So there's several different types of ISA out there, including cash ISA, which can be open from age 16, and stocks and shares ISA, which can be open from age 18, and the lifetime ISA, which we'll look at in more detail shortly. You can generally only pay into one of each type in a given tax year, so it's worth doing some research to find out which is likely to best meet your needs. So, for example, some ISAs enable easy instant access, which may be preferable if you need to dip into your savings, whilst others offer fixed term deals, for example, giving you a higher rate of growth if you lock the money away without withdrawing any. You can transfer money you've invested in an ISA during the current year, but you must transfer all of it. So whilst pensions are currently accessible from age 55, if you have savings which you may want to access before you reach retirement, then it could be worth looking at ISAs for these savings. But remember that once you've withdrawn the money from an ISA in a given tax year, you cannot usually replace that amount. So for example, if you put £8,000 into an ISA and later in the year withdraw this, you will only have the remaining £12,000 to contribute to ISAs that year. If you do want to replenish savings that have been taken out during the tax year, then you should look for a flexible ISA, but not all providers offer this option. Now, the next type of ISA I want to share with you is the lifetime ISA, or the LISA. Now, LISAs were introduced in April 2017 as a replacement for the Help to Buy ISAs, which closed to new applicants in November 2019. And the LISA can only be opened by anyone aged 18 to 39, allows you to save up to £4,000 a year towards your first home or retirement, with the government providing a 25% cash bonus of up to £1,000 a year on top. And as it's an ISA, any interest on your savings is tax-free. Now, LISA contributions can continue up to the age of 50, and funds can be withdrawn tax efficiently from age 60 or earlier if buying your first home. If you are buying a home with someone else, you can both take advantage of separate lifetime ISAs. So if you were to open a LISA at age 18 and pay in until you're 50, the maximum government bonus you'll receive is £33,000, assuming the annual £4,000 limit remains, of course. Remember that whatever you pay into a LISA will count towards the overall annual ISA contribution limit of £20,000, but you can consider paying any further savings into one or more of any other types of ISA. Now, under normal circumstances with the LISA, you'd be charged a 25% penalty of the amount withdrawn if you took money out before you turned 60, or if you're not buying a property. However, between 6th of March 2020 and 5th of April 2021, this penalty drops to 20% on withdrawn funds, which is essentially equivalent to repaying the bonus. Now, as is the case with normal ISAs, once you've opened a LISA, you don't have to stick with the one that you chose at the start. Interest rates can increase and decrease, so if you do spot a better deal, you do have the option to transfer elsewhere to take advantage of this. Just make sure that you would check any restrictions with your provider first. If you transferred a LISA to a normal ISA, however, you would incur the 25% penalty on this. So we talked about the options open to adults, but what about saving into an ISA for children to get them started on their savings journey? So junior individual savings accounts, or JISAs, are long-term tax-free savings accounts for children, with any money that you pay in locked away until your child's 18th birthday. At this point, it becomes their cash, which they can access and turn into a standard ISA. So in the 2021 tax year, the savings limit for junior ISAs is £9,000, and this can be spread across a cash junior ISA and stocks and shares junior ISA, or one of each. At ages 16 and 17, they can open their own junior ISA as well as an adult cash ISA, meaning in those years they have a total ISA limit of £29,000. That's £20,000 in the cash ISA and £9,000 in the junior ISA. The key reason for opening a junior ISA is that interest or investment returns are tax-free. So if a parent or a step-parent contributes to a child's savings, they can only earn a maximum of £100 interest a year before it all becomes taxable at the parent's tax rate. And this £100 is regardless of how many children it's split over. So putting it into a junior ISA, however, means that all interest is tax-free. It is worth remembering, however, that whilst parents or guardians with parental responsibility can open a junior ISA and manage the account, the money belongs to the child. And once they turn 18, you will not have control how the money is spent. So even though you may have had plans for them to spend it on a deposit for their first home, for example, they are free to do whatever they like with it, which might be not what you had in mind. So I suggest weighing up the benefits of a junior ISA against a savings account or indeed a pension when putting money aside for your child's future. So that was a whistle-stop tour of various types of savings vehicle and some of their key features. To wrap up the session today, let's go through some of the top tips that we've looked at. So firstly, have a look at your payslip and check whether your tax code looks right. Remember that you can be paying too much or too little tax if it's wrong, so it's worth sorting out any errors sooner rather than later. If you and your partner earn less than £12,500 a year, so that's you and your partner, you or your partner rather, earn less than £12,500 a year, consider whether the marriage allowance might be right for you to save tax between the two of you. Also look at how much you're paying into your pension and whether you can afford to be paying in more. The pension calculator will give you an idea of whether you're on track to what you're on track to receive in retirement and the projected impact of additional payments. Remember, if you're a high or additional rate taxpayer, to see whether you can claim back additional relief from HMRC, who, as I've mentioned, will usually go back up to about 4 years in respect of unclaimed relief. Have you made use of your ISA allowance for the tax year? These savings can sit alongside your pension savings, but with the option to be accessible when you need to dip in. So keep an eye on interest that you're getting to ensure that, of course, you're getting the best and the most for your savings. Now, it's a good idea to budget your savings to work out how much you may be able to comfortably afford to save in the upcoming tax year, looking at where you could reduce your outgoings or which debts are seen to be paid off, for example. And you can download the budget planner on the Better With Money website to help you with this. So this planner will help to break down your monthly outgoings against your income so you can create a savings budget. Depending on what these savings may be used for, you can then allocate to various different vehicles accordingly. Remember, with any saving, to try to find that balance with living for today and saving for tomorrow. Now, if you do decide to take advice on your finances, make sure this is from someone reputable that is registered by the Financial Conduct Authority. There's a tool called Unbiased that you can use to check for advisors by location. And it's not uncommon for advisors to offer a free financial health check or initial consultation, which can help to work out whether they're a good fit for you. Your pension provider may also give you the option to access up to £500 from your pension pot to pay for financial advice, and this is known as the pension advice allowance. You can do this once a year, up to 3 times without a tax charge, and not all pension schemes provide it, so do check what yours offers. Please remember the ICE Benevolent Fund and Support Network are here to help you and your family too, and you can find further information about the services available on the websites, or you can contact them at the phone numbers and email addresses provided. And lastly, here's a couple of links to some useful sites to get guidance on your savings. There are plenty of resources for you to download on the Better With Money website, plus help and guidance from services such as the Money Advice Service and the Money and Pension Service.